Have you ever been organizing your kitchen and you accidentally label the salt jar as sugar?
Oh, that is a classic disaster waiting to happen.
Right, because you go to bake a cake, you measure everything out perfectly, you follow the recipe to the letter, but when you pull it out of the oven and take a bite, it is just completely ruined.
Because you put a crucial ingredient into the completely wrong mental folder.
Exactly. And it's not because you lacked information. I mean, you knew exactly how many cups to use. The cake is ruined because your categorization was wrong from the very first step.
But the outcome was basically doomed by a taxonomy error.
Yeah, a taxonomy error. And welcome to this custom deep dive, by the way. Today, we have a really fascinating mission. We're looking through a stack of sources that reveal how the world's most sophisticated financial markets are currently making, well, that exact kitchen mistake.
But on a global systemic scale, which is terrifying.
Right, on a massive scale. They're observing major structural changes in the global economy, and they're just filing them in completely wrong categories. The sources actually refer to this as the geometry of misclassification.
Which is, it's just a really powerful framework for understanding market failures. When you look at a data point from the wrong angle, you inherently misprice the risk.
Yeah.
We are currently watching the market take these massive structural fiscal crises and casually toss them into the jar labeled geopolitics.
And I really want to break down why that happens, because there's a massive difference between, like, a cyclical risk, the normal ups and downs of the market, and a structural risk.
Right, where the actual rules of the game have changed.
Exactly. It seems like financial models are built for the former, but they're completely blind to the latter.
Well, financial markets and their algorithmic trading models are incredibly good at pricing cyclical weather patterns. They know how to react to, say, a bad earnings report or a temporary supply hiccup.
A sudden storm.
Exactly. But structural risks are like climate change. The models assume the foundational climate is a constant. So when that foundation shifts, the models just don't know how to read it.
So they just categorize the event as temporary diplomatic noise?
Yeah, they just wave it away.
And the biggest real-world example of this is unfolding right now with the United Arab Emirates and OPEC. If you glance at the headlines this week, the narrative is entirely framed around Gulf realignment.
Purely political.
Yeah. The story is that Abu Dhabi is frustrated with bilateral disputes over production quotas, and so they made the sudden decision to exit the OPEC cartel.
Yeah.
The news is just treating it as a diplomatic spat.
Right. So the equity desks at major banks looked at this, filed it under Middle Eastern geopolitical drama, and just moved on.
Wow.
The geopolitical analysts write their newsletters, sure, but they rarely walk across the trading floor to tell the sovereign credit desks that the fundamental architecture of global oil just cracked.
So they completely missed the financial impact.
I mean, this is not a geopolitical story. This is a massive sovereign credit event.
But if you're, a trader sitting on a desk in London, you're probably looking at this and thinking, well, it's just one country leaving. Saudi Arabia is still there. The cartel keeps functioning.
Right. That's the surface level take.
So why is that trader wrong? Exactly what is the mechanism that they are missing here?
That trader is looking at the surface optics and ignoring the underlying math. In the architecture of global oil, the UAE isn't just a regular member. They are the primary swing producer.
Okay, meaning what exactly?
Meaning they possess the highest production capacity combined with the lowest breaking cost to pump that oil. Historically, they have the strongest incentive to comply with the cartel's rules. They single-handedly held the price floor together.
So the foundation of the market's oil pricing just literally walked out the door.
Basically, yeah.
Let's look at the mechanism of how this impacts other nations then.
Yeah.
Because the sources point heavily to the International Monetary Fund, the IMF, and their Article IV consultations.
Right. So an Article IV consultation is essentially a comprehensive economic health check the IMF performs on a country.
Kind of like a physical.
Yeah, exactly like a physical. For an oil-dependent nation, that health check determines whether they can balance their national budget, pay for public services, or, crucially, service their national debt.
Okay.
And to run that math, the IMF has to assume a future price of oil.
In the IMF's current models, like the October 2025 World Economic Outlook, they explicitly assume that OPEC plus coordination will hold together as a structural constant through 2026.
Right. That is the core denominator in that massive economic equation. The UAE's compliance was key to that. With the UAE gone, that denominator has structurally changed.
Even with other countries stepping in.
I mean, we've seen Saudi Arabia and Kazakhstan step up to reassure the markets that they'll maintain coordination, but verbal reassurances cannot mathematically plug the structural hole left by the departure of the primary swing producer.
It's like it's like pulling the main load-bearing pillar out of a building, but assuming the roof will stay up just because the remaining pillars promise to be really strong.
That is a perfect analogy. And the danger of that assumption is magnified when you look at the real-time data for credit spreads.
Right.
A credit spread is basically the premium or the extra interest rate that investors demand to hold the debt of these oil-producing nations compared to safe assets.
So a higher risk means a higher spread.
Exactly. If investors actually understood the risk of the UAE leaving, those spreads should be skyrocketing right now.
Which reveals a massive disconnect because they aren't.
No, they aren't.
Investors are effectively flying blind because their instrument panels are just frozen. I mean, if those spreads did adjust appropriately, borrowing costs for countries like Nigeria or Angola would jump overnight.
Oh, they would potentially face an immediate sovereign debt crisis. Nigeria's IMF debt sustainability model, for example, assumes they need oil to be around $77 a barrel just to break even on their budget.
Wow, $77.
Yeah. And Angola's trajectory for building its national reserves explicitly assumes there will be no OPEC fragmentation.
Which just happened.
Right. So if their borrowing costs spike because the oil floor drops, they might have to slash domestic public services just to pay foreign bondholders.
And this is happening without any domestic crisis in Lagos or Luanda. Like, they didn't mismanage their local economies this week, but the structural assumption keeping them afloat just completely evaporated.
Yep.
The market thinks, OPEC plus will hold, the conflict in Iran is creating a supply shock, everything is fine. They are pricing the cartel's coordination as a constant, while the UAE just made it a variable.
Which brings us to the next layer of this taxonomy error.
Right, because we just saw what happens when a financial floor, the price of oil evaporates. But the market is equally blind when physical floors evaporate.
Absolutely.
Because Kazakhstan is currently experiencing a double whammy, and the market is missing both hits.
Kazakhstan is really the textbook case study for compounding errors here.
So, last week, Russia restricted the flow of Kazakh oil through the Caspian Pipeline Consortium, the CPC. Now, the market algorithms looked at that and, once again, put it in the wrong jar. They flagged it as European energy geopolitics.
Which is a dangerously incomplete categorization because it isolates the event. If we read the fine print of the IMF's Article IV for Kazakhstan, the fund explicitly flagged OPEC plus price volatility as a high probability, high impact risk.
Okay, so they saw it coming.
They did. Their explicit recommendation to Kazakhstan was to save any windfall oil revenues in their national oil fund, known as the NFRK, to prepare for a rainy day.
But I mean, to save money, you actually have to be able to sell the oil at a high margin first, right?
Exactly. The NFRK needs cartel discipline, that financial price floor, to accumulate those reserves. Its entire accumulation model requires OPEC to hold together so Kazakhstan can extract maximum value.
Synthesizing this, in consecutive weeks, Kazakhstan lost the reliability of its primary physical pipeline because of Russia.
Yep.
And they lost the reliability of the global financial price floor because the UAE left OPEC.
Exactly.
The IMF explicitly warned them about this exact scenario, and yet the market spread didn't respond to either event.
Because algorithmic trading models just don't read compounding structural violations well.
They just see them as separate blips.
Right. They saw the pipeline restriction as a localized European diplomatic issue and the UAE exit as a Gulf diplomatic issue. The models completely failed to see that both events are attacking the exact same pillar of Kazakhstan's fiscal framework.
So moving from pipelines to broader physical geography, national transit routes, what the sources call corridors, seem to be the next big blind spot that the market is completely underpricing.
Corridors are the physical arteries of the global economy, entirely taken for granted until they get blocked. And right now, Mongolia is acting as the canary in the coal mine for this specific risk.
The sources highlight that Ulaanbaatar, the capital of Mongolia, is actively courting Kazakhstan right now as an alternative transit partner.
Right.
And if you're casually scrolling the news, you might think, oh, that's just a friendly diplomatic visit.
But it is far from a courtesy call. It is a full-blown sovereign treasury panic.
Wait, really? Why a panic?
To understand why, you have to look at a map. Mongolia is completely landlocked. Its entire economic survival relies on two primary transit corridors to move its goods, China to the south and Russia to the north.
And both of those corridors are under immense structural stress right now.
Massive stress. Russia is heavily distracted. They're trying to manage their OPEC plus positioning while simultaneously dealing with the massive logistical strain of the war in Ukraine.
Right.
They're not acting as a stable, reliable transit partner for Mongolian exports right now.
And on the southern border, China is actively restructuring its resource strategy. Like, they just granted tariff-free access to 53 African nations.
Which is a massive pivot.
Yeah, that's huge.
It means Chinese procurement might start edging out Mongolian suppliers in favor of African imports. Mongolia is looking at the north and the south and realizing they are essentially trapped.
Wow. And when we look at the IMF model for Mongolia, the Article IV assumes that both of those transit corridors, Russia and China, are completely stable.
Yes, that's the baseline assumption. But the ground truth says otherwise, and there is no magical third corridor available for Mongolia to use.
So that's why they're talking to Kazakhstan.
Exactly. They are courting Kazakhstan because they are desperate for an alternative route. But the financial markets haven't priced in the risk that Mongolia might simply lose physical access to its buyers.
And the sources provide a really brilliant contrast to this when looking at the ASEAN region, the Association of Southeast Asian Nations.
Oh, this is a fascinating comparison.
We have two countries, Vietnam and the Philippines, dealing with the exact same external shock, which is commodity inflation driven by the conflict involving Iran. But they have entirely different corridor strategies, and the market is treating them exactly the same.
The divergence in their structural defense mechanisms is just profound.
So Vietnam just completed a major visit to China, securing extensive rail, airline, and security deals. Meanwhile, the Philippines has no such bilateral anchor in place.
Right.
It's like Vietnam is a business that just built a private, direct VIP tunnel right to the factory.
That's a great way to put it.
They have a corridor hedge.
Yeah.
They can negotiate transit and absorb the shock through a managed channel. The Philippines is just a regular customer stuck outside, forced to absorb all that inflation by buying everything on the open, volatile market.
And what's critical to understand here is how the bond market and rating agencies actually grade this debt. The agencies are largely just plugging historical inflation data and reserve levels into a spreadsheet.
They aren't looking at a map.
No, they don't have a metric for physical supply chain geography.
Yeah.
They don't measure the defensive value of Vietnam's new VIP tunnel.
So they're running purely on backward-looking financial data, completely blind to the physical reality on the ground today.
Yeah. And as a result, the market spreads haven't differentiated between Vietnam and the Philippines at all. Despite this massive divergence in structural safety, the bond markets are treating them as relatively similar risks.
That is wild.
The IMF frameworks for these countries weren't calibrated to absorb the current levels of commodity prices without those structural defenses, yet the market pretends the risk profile is identical.
We've seen what happens when the market puts a negative structural shift into a harmless geopolitics jar.
No.
But the sources also explore what happens when the market tries to price two completely contradictory things at once and somehow files them both in the positive jar.
Yeah, Pakistan is currently running a masterclass in contradictory narratives for the market.
Right now, the market is pricing in a peacemaker premium for Pakistan because of peace talks being mediated by China.
Right.
Investors look at the headline and algorithmically price in diplomatic stability, meaning less risk. But at the exact same time, the Taliban just accused Pakistan of launching a military strike on an Afghan university. And that is the first military action since those peace talks began.
The cognitive dissonance here requires us to really look at the underlying mechanics. I mean, you cannot simultaneously have a peacemaker premium while actively engaging in a border conflict.
Obviously not.
The bilateral creditor architecture that supports Pakistan's IMF extended fund facility was already structurally strained.
They were already on incredibly thin ice with their international lenders.
Exactly. Diplomatic mediation might look good on a sentiment tracker, sure, but a deterioration in hard security is a fundamental risk to the stability of their IMF program.
Because diplomatic optionality and balance of payments stability are not the same thing.
No, they don't offset each other. They compound the overall risk. Yet, the algorithms are choosing to price the momentum of the peace talks while completely ignoring the military strike because, well, it doesn't fit the established narrative.
The market is just holding its hands over its ears. But here is perhaps the most fascinating part of the Pakistan equation, and the threat comes from a place you would never expect: the Bank of Japan. Now, I understand that Japan raising interest rates is a big deal for them domestically, but I'm really struggling to see the mechanism that connects a boardroom in Tokyo to a sovereign debt crisis in places like Pakistan, Kenya, or Egypt.
It seems like a stretch, right?
It really does.
Yeah.
Walk me through that chain reaction.
The chain reaction starts with the engine that funds a massive portion of emerging market debt. It's a mechanism called the carry trade.
Okay, for those listening who might not be deep in Forex trading, let's break down the actual plumbing of how that carry trade works.
Sure. In global finance, investors constantly look for arbitrage, basically ways to exploit differences in prices. For years, the Bank of Japan has kept their interest rates extremely low, often below zero.
Right.
So institutional investors borrow massive amounts of money in Japanese yen because the borrowing cost is virtually nothing. They take that cheaply borrowed money, convert it, and use it to buy high-yield government bonds in emerging markets like Pakistan or Kenya.
So they basically pocket the difference between the near-zero cost to borrow the yen and the high interest rate Kenya is paying on its bonds.
Exactly. It's basically free money, provided one massive structural assumption holds true, that the Bank of Japan will keep their interest rates near zero, keeping the borrowing costs cheap.
And this week, that structural assumption cracked.
Yes, it did. The Bank of Japan held what the sources call a hawkish hold.
Meaning?
They didn't raise rates at this specific meeting, but the internal dynamics shifted violently. There were 3 dissenting board members who actively wanted tighter policy. They officially raised their inflation forecasts.
Oh, wow.
And Governor Ueda gave explicit signals that rate hikes are imminent. Furthermore, we saw actual market intervention by Japan to prop up the value of the yen.
So the cheap money that investors were relying on to buy the debt of Pakistan and Kenya is about to get a lot more expensive.
Significantly more expensive.
And if the cost to borrow yen goes up, those investors will start duping their emerging market bonds to pay back their loans.
That is exactly what happens. This is a carry funding regime change. Yields in emerging markets will suddenly have to compete with higher baseline global costs, risking massive capital flight from vulnerable economies.
That is terrifying for those countries.
It is. And again, the market algorithms are treating the Bank of Japan's announcement as a routine monetary policy update, rather than the structural earthquake it actually is for global liquidity.
When you pull back and look at the sequence we just walked through, the geometry of misclassification is just everywhere.
It really is the defining analytical error of our current moment, constantly prioritizing cyclical patterns over structural realities.
Think about the timeline. In a matter of days, we saw the CPC pipeline suspended, cutting off physical oil flows. We saw OPEC fragment with the UAE's exit, breaking the global financial price floor for energy.
Right.
We saw the Bank of Japan signal a regime shift that threatens the core funding mechanism of emerging market debt. And we saw Mongolia actively panic over the viability of its transit corridors.
Sequences like that are not coincidences. As the sources point out, they are overarching structural theses wearing different daily headlines.
If you are an analyst and you are looking at all this through the wrong angle, your models are going to tell you everything is fine.
You're going to pour the salt into the cake batter, completely confident that it's sugar.
Right up until the moment you take a bite and realize the disaster. It makes you wonder, in your own life or your own work, are you misclassifying major structural shifts as just temporary drama? Are you missing the foundation cracking because you're too focused on the paint peeling?
The costliest error in any complex system isn't missing the data, it's miscategorizing it. If your taxonomy is flawed, your entire response mechanism fails.
We've seen today that the financial markets models completely fail to adjust when a structural assumption, like an OPEC floor, a guaranteed transit corridor, or cheap Japanese borrowing, suddenly turns into a variable.
Their taxonomy is incredibly rigid.
They try to shove world-altering events into tiny pre-labeled jars. So I want to leave you with this final lingering thought based on everything we've uncovered. We know the market is blind to events that technically do fit into their existing jars, just the wrong ones.
Right.
But what happens to global credit spreads when a crisis occurs that fits into absolutely none of their existing categories? Do the mathematical models simply break?
That is a terrifying and very real possibility we may soon have to face.
Thank you so much for joining us on this deep dive. Keep questioning the labels, and we'll see you next time.